The option strategy used by Danish is a covered call option strategy. This strategy is applied when an investor already owns the underlying shares and sell call option on those same shares. In Danish case, he owns 200 shares of LMN Ltd, which means the call option he sells are fully covered by his existing shareholdings. This is considered a relatively conservative strategy because if the option buyer decides to exercise the call option, Danish does not need to purchase shares from the market. Instead, he can simply deliver the shares he already owns. Dennis chooses this strategy because he expects the stock price to remain stable or increase slightly but not rise significantly within the next month. By selling the call option, he sacrificed some potential upside in exchange for earning immediate income from the option premium. Moving on to the total premium income received from selling the call option. The premium received per share is Rm 1.50 ringgit. Each option contract represents 100 shares and Danish sells two contracts because he owns 200 shares in total. To calculate the total premium income, we multiply the premium per share by the contract size and the number of contracts sold. So, the calculation is Rm 1.50 ringgit multiplied by 100 shares multiplied by 2 contract, which give a total premium income of Rm 300. This 300 is received upfront and is guaranteed income for Danish regardless of how the share price move at expiry. Next, the break-even price of the covered call strategy is determined. The break-even price shows the minimum share price at which Danish will not make a loss. For a covered call strategy, the break-even price is calculated by subtracting the premium received per share from the original purchase price of the share. Danish purchased the shares at Rm 30 ringgit per share and he received Rm 1.50 ringgit per share as premium. Therefore, the break-even price is Rm 30 ringgit minus Rm 1.50 ringgit, which equals Rm 28 ringgit 50 cent. This means that as long as the share price remains above Rm 28 ringgit 50 cent, Danish will not incur a loss. The premium received effectively reduces his cost of investment and provide limited downside protection.
Hi, my name is Binti Rumaizi, and next we move to the question 4. This question required us to calculate the maximum profit for Danish. So maximum profit occurs when the stock price reach or exceed the strike price of 35 ringgit Malaysia at expiration. So at this point, share will be called away, so Danish cannot benefit any further increase of the stock price. The profit comes from two parts, which is first, profit from the stock price increase, and second is the premium received from selling the call option. So profit from the stock is calculated as strike price minus with purchase price times with number of share. That is 35 ringgit Malaysia minus with 30 ringgit Malaysia, and then times with 200 unit of share. Then we get amount of 1,000 ringgit. Then we add the premium received, which is 1,000 ringgit plus with 300, and then we get the amount of 1,300 ringgit Malaysia. So the maximum profit is 1,300, and it occurs when the stock price is 35 ringgit or higher. So no matter how high the stock price goes beyond the 35, the profit is capped at 1,300 ringgit. So next we move to the question 5, where we have to calculate the minimum losses for their niche. So the maximum we have to calculate the maximum loss for their niche. So the maximum loss occurs when the stock price falls to zero, meaning the shares become worthless. So in this situation, the niche only keeps the premium received. So the formula is maximum loss equals to purchase price times with number of shares minus with total premium. So the calculation is 30 ringgit Malaysia times with 200 minus with 300, which give maximum loss of 5,700 ringgit. This shows that the premium received is slightly reduced the loss compared to holding the stock alone. So here, the option premium acts like a small protection against the downside risk. Moving on to question 6, where I will explain the profit or loss at different stock price at expiration using the formula shown. So the formula is profit or loss equals to ending price minus with purchase price times with 200 plus premium minus with option payoff. So when the stock price falls to 25 ringgit Malaysia, the option expires worthless. So the calculation results in loss of 700 ringgit Malaysia. At stock price 28 ringgit Malaysia, the stock is below the purchase price. So after adding the premium, the loss is reduced to 100 ringgit Malaysia. When it comes to stock price at 28 ringgit and 50 cent, which is the breaks even, this happened because the loss from the stock is exactly offset by the premium received. So the calculation results in 0. So this known as the break-even point. Moving on to the stock where the price is 33 ringgit Malaysia, the stock has increased in value and the option is still not exercised. So Danish earned a profit of 900 ringgit Malaysia. At 35 ringgit Malaysia stock price, the option is exercised. This is where Danish achieved the maximum profit of 1,300 ringgit. And when the stock is 38 ringgit, even though the stock price rises to 38 ringgit Malaysia, the profit is still remain as 1,300 ringgit because gains are capped at the strike price. So that's all from me. Thank you.
Okay, Assalamualaikum. So I will explain about the question 7. So the question 7 state that draw and label the payoff diagram for the covered cost strategy. So let's dive into the technical breakdown of our covered cost strategy. So to understand our potential return, we look at the two main components, the profit from underlying stock and the premium income. And then, based on our calculation, the profit from stock is captured as the difference between the RM35 ringgit strike price and our RM30 ringgit purchase price for 200 ringgit, totaling of 1,000 ringgit. When we add the RM300 premium, we receive upfront and we reach at cap maximum profit of 1,300 ringgit. And then, when we look at the payoff diagram, we can see how these position interact. The dotted line represent the individual long stock and short call position, while the solid diagonal line represent the combination of a call outcome. So a critical feature here is our break-even point at 28 ringgit 50 cent because the premium provide a financial buffer. The market price at maturity can actually drop slightly below our RM30 ringgit purchase price before we face an actual loss. So this diagram showed that while our upside is limited beyond RM35 ringgit strike price, we have effectively lowered our risk and increased our yield in a neutral market. let's go to the question 8. So based on your analysis, comment on whether this strategy is suitable for Danish market expectation. So now we must address whether this strategy aligns with Danish specific goals. Based on the analysis, the answer is definitely a yes. And this is the most effective strategy for his current market expectation. Danish anticipate that the stock price will either remain stagnant or show only marginal growth. In such a market, simply holding the stock might yield little to no return, but by selling the call, he generate RM 300 ringgit in a short-term revenue. And then, this premium serve a dual purpose. It cushion him against a low price sell-off and allow him to capture the marginal revenue in what he view as an inelastic market, while he does forget the upside profit if the stock were to shoot past RM 35 ringgit, and he already determined that such a spike is unlikely. Therefore, the covered call stand a perfect method for Danish to monetizing his holding while protecting his downside.
Assalamualaikum and good day. My name is Amirah Nadhirah, and now let us move on to case study 2. For this question, we are required to construct a binomial option pricing model or BOPM. First, let me briefly explain what this model means. The binomial option pricing model is a method used to determine the value of an option by modeling the possible movements of a stock price over time. In each period, the stock price can move into two possible states, which are up and down. This model can be applied to both European call options and European put options. Since the question specifically mentions a call option, we will focus on European call options. Now, let us look at the information given in the question. The strike price is RM 30 ringgit, while the current stock price is RM 35 ringgit 50 cent. The time to expiration is 3 months. The stock volatility is 10% per month. The upward probability is 70%, and the risk-free interest rate is 2% per month. It is also stated that the stock price moves on a monthly basis. The first step is to determine the number of periods, or we call as N, and the time step indicate as changes of T. Since the total time to expiration is 3 months and the stock moves monthly, the number of periods is N equal to 3 divided by 1, so the answer is 3, which means this is a 3-period binomial model. Next, we convert the time to expiration into years. 3 months divided by 12 months gives T equal to 3 divided by 12 equal 0.25 years. Then, we calculate the change in time, which is T divided by N equal to 0.25 divided by 3. The answer is 0.0833. Since the risk-free rate interest rate is given as 2% per month, we need to convert it into an annual rate. Therefore, 2% times with 12 equal to 24% per annum. After that, we calculate the discount factor using the formula 1 plus interest rate times with changes of T raised to the power of N. So, the value is 1 plus 0.24 times with 0.0833 raised to the power of 3. The answer is 1.0612. Next, we determine the up and down factor. The formula for the up factor is 1 plus with volatility while the down factor is 1 minus with volatility. Given that the stock volatility is 10%, the values are up factor equal to 1.10, meanwhile for down factor equal to 0.90. Lastly, we determine the probabilities. The upward probability is given as 70%, so the downward probability will be 1 minus with 70% equal to 30%. Now that we have determined all the required components, we can proceed to construct the stock price tree.
Now moving on to the binomial tree, the probability upward is 70% and the probability downward is 30%. Begin with the market price. We have to times with 1.1, which is equal to 39 ringgit and 5 cents for the value of upward factor value, and 35 ringgit and 50 cents we have to time with 0.9 for the downward factor value. There are two prices, so the first price is 39 ringgit and 05 cents. Again, we have to times with 1.1, which is equal to 42 ringgit and 95 cents, and 39 ringgit 5 cents we have to times also with 0.9, which is equal to 35 ringgit and 15 cents for the downward factor value. For the second price is 31 ringgit and 95 cents. We have to time with 1.1, which is equal to 35 ringgit and 15 cents again for the upward factor value. And 31 ringgit and 95 cents we have to times with 0.9, and it's equal to 28 ringgit and 76 cents for the downward factor value. And there are three prices in total on the second month, on the month 2. And for the first price is 42 ringgit and 95 cents. We have to times with 1.1, which is equal to 47 ringgit and 26 cents. And again, 42 ringgit and 95 cents we have to times with 0.9, which is equal to 38 ringgit and 66 cents for the downward factor value. For the second price is 35 ringgit and 15 cents times is 1.1, it's equal to 38 ringgit and 66 cents again. And 35 ringgit and 15 cents times with 0.9, it's equal to 31 ringgit and 64 cents for the downward factor value. For the last price is 28 ringgit and 76 cents times with 1.1, it's equal to 31 ringgit and 64 cents. And 28 ringgit 76 cents times with 0.9, it's equal to 25 ringgit and 88 cents for the downward factor value. Now we have to list all the probability based on the four price. And for the first price at 47 ringgit and 26 cents, it has only one probability, which is MP triple U. The second price is 38 ringgit and 66 cents. It has three probability, which is MPUUD, MPUDU, MPDUU. And the third price is 31 ringgit and 64 cents. It also has three probability, which is MPUDD, MPDUD, and also MPDDU. And the last price is 25 ringgit and 88 cents. It only has one probability, which is MP triple D. And for the payoff option price, we have to minus the last four price with the strike price. So the first price is 47 ringgit and 26 cents minus with 30 ringgit, and it's equal to 17 ringgit and 26 cents. So the second price is 38 ringgit and 66 cents minus with 30, it's equal to 8 ringgit and 66 cents. And third price is 31 ringgit and 64 cents minus with 30 ringgit, it's equal to 1 ringgit and 64 cents. And the last one is 25 ringgit minus with 30, it's equal to 0 because payoff option value cannot be at negative. Now, calculate for expected payoff. The amount of option payoff, we have to times with the probability. So the first price is 70 ringgit and 26 cents. The way to calculate is 0.7 the power of 3 times with 17 ringgit and 26 cents, and it's equal to 5 ringgit and 92 cents. For second price is 8 ringgit and 66 cents. The way of calculate is 3 times 0.7 the power of 2, because there are two upward probability, and times with 0.3 times with 8.66, and it's equal to 3 ringgit and 82 cents. For the third price, also have three probability, which is one upward and two downward. So the way of calculate is 3 times 0.7 times 0.3 the power of 2, and time 1 ringgit and 64 cents, which equal to 0.35. 31, sorry. And the last one is 0. For the price of 0, it's the way of calculate is 0.3 with the power of 3 times RM0, it's equal to 0. Now for the call option, we have to total up with the expected payoff, which is 5 ringgit and 92 cents plus 3 ringgit and 82 cents plus 13 cents and plus 0 ringgit divided by discount factor, which is 1.0612, and it is equal to RM 9 ringgit and 47 cents.